What if I told you that your daily coffee money could buy you financial freedom? Stay until the end of this video and I'll show you exactly how to turn just $20 a week into a dividend stream that could cover your rent. No tricks, no scams. Just pure investment strategy that the Wall Street elite use themselves. And don't click away, because at the end I'm sharing my personal ETF watch list that's generating passive income right now. Welcome back to Wall Street Trends, where we turn complex money moves into simple strategies you can start using today. If you're new here, hit that subscribe button and notification bell, because we're dropping game-changing financial content every week that you won't find anywhere else. Keep watching because in just a few minutes, I'll reveal the exact ETF that turned my $20 weekly investment into a steady dividend stream. What are ETFs? Before we dive in, let's understand what ETFs are. ETF stands for Exchange Traded Fund. Think of it as a basket of different stocks all bundled together. When you buy an ETF, you're essentially buying tiny pieces of hundreds of companies at once. This gives you instant diversification. You're not putting all your eggs in one basket. Why ETFs are the perfect choice? First things first, why ETFs? Exchange-traded funds, or ETFs, are one of the best ways to grow your wealth over time because they offer diversification. You're not putting all your eggs in one basket. You're investing in a mix of stocks, bonds, or sectors. Low costs. Most ETFs have lower fees compared to mutual funds. Dividend potential. Many ETFs pay regular dividends, which can become a source of passive income over time. The power of starting small. Now, $20 a week might not sound like much. That's about the cost of 3 fancy coffee drinks or 1 dinner delivery. But here's where the magic of compound interest comes in. $20 per week equals $80 per month equals $1,040 per year. Over 30 years, assuming a 7% average annual return, which is conservative for the S&P 500 historically, you could accumulate around $89,000. And that's just with the basic $20 weekly investment. But here's the kicker. If you're investing in dividend-paying ETFs, your portfolio will not only grow in value, but also start generating passive income, which we'll discuss next. Dividend income, your passive cash flow. Dividend ETFs typically yield around 2 to 4% per year, depending on market conditions and the specific ETF. Let's assume you have a portfolio worth $100,000 and your ETF pays a 3% annual dividend. That's $3,000 per year, or about $250 per month, which could help cover part of your rent, utilities, or even groceries. And remember, as you continue investing and reinvesting dividends, this amount grows year after year. Choosing the right ETFs. Choosing the right ETFs is crucial to maximizing your returns and ensuring your portfolio aligns with your long-term goals. Let's take a closer look at some top-performing dividend ETFs and compare them based on key factors such as dividend yield, expense ratio, historical performance, and risk level. Let's break these down to help you pick the right one for your investment style and goals. Vanguard High Dividend Yield ETF, VYM. Best for investors looking for a solid, well-diversified, and low-cost ETF with stable dividend payouts. Key highlights: holds over 400 large-cap U.S. companies such as Johnson & Johnson and Procter & Gamble. Dividend yield, around 3.0% to 3.5%. Expense ratio, ultra low at 0.06%, meaning more money stays in your pocket. Growth potential, solid long-term performance with low volatility. Downside, not as high yielding as some other ETFs, but offers stability. Schwab U.S. Dividend Equity, ETF, SCHD. Best for those who want a combination of high yield and strong dividend growth over time. Key highlights: focuses on 100 high-quality dividend-paying U.S. stocks, such as PepsiCo and Home Depot. Dividend yield, around 3.5% to 4.0%. Expense ratio, extremely low at 0.06%. Growth potential, strong capital appreciation with reliable dividend increases. Downside, slightly concentrated portfolio compared to VYM. SPDR S&P 500 ETF, SPY. Best for investors seeking broad market exposure with growth potential. Key highlights. Tracks the performance of the S&P 500 index, offering exposure to companies like Apple and Microsoft. Dividend yield. Lower at 1.3% to 1.5%, but offers strong price appreciation. Expense ratio. 0.09%, slightly higher than others. Growth potential. High, as it includes leading U.S. companies across all sectors. Downside. Lower dividend payouts compared to dividend-focused ETFs. iShares Core Dividend Growth ETF, DGRO. Best for investors focused on companies that consistently grow their dividends over time. Key highlights. Invests in companies with a track record of increasing dividends, such as Visa and Microsoft. Dividend yield, around 2.0% to 2.5%. Expense ratio, low at 0.08%. Growth potential, steady long-term appreciation. Downside, lower initial yield compared to high-yield options but offers higher growth. Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. Best for conservative investors looking for steady income with lower market volatility. Key highlights. Holds 50 of the highest-yielding, lowest volatility S&P 500 stocks. Dividend yield. Highest on this list at 4.0% to 4.5%. Expense ratio, higher at 0.30%. Growth potential, moderate, with a focus on minimizing market downturn risks. Downside, higher fees and limited diversification. So, how do you decide which one is right for you? If you want steady dividends with low risk, go for VYM or SCHD. If you prefer growth with some dividends, SPY might be a good fit. If your goal is long-term dividend growth, consider DGRO. If you want high immediate dividends, then SPHD is worth considering. Regardless of which ETF you choose, the most important thing is to stay consistent with your contributions and reinvest your dividends to take full advantage of compounding. The compounding effect. Let's break down how your money grows. You invest $20 in dividend-paying ETFs. These ETFs pay dividends quarterly. You reinvest these dividends to buy more shares. Your larger number of shares generates more dividends. The cycle continues and accelerates, building towards financial freedom. Now here's how this turns into passive income. After 30 years of $20 weekly investments, assuming a 3% dividend yield, your $89,000 could generate about $2,670 in annual dividends. That's $222.50 per month in passive income. Scaling up over time. The beauty of this strategy is that you can scale up as your income grows. Start with $20 a week. Increase by $5 a week each year. After 30 years with the same 7% return, you could have closer to $150,000. This could generate around $4,500 annually in dividends. Making it work in real life. Getting started is easier than you think. Here's a simple step-by-step process. Open a brokerage account. Set up automatic contributions. Automate your $20 weekly investment to stay consistent. Choose your ETF and start investing. Pick one or a mix of ETFs and stick with your plan. Reinvest dividends. This will help your portfolio grow faster through compounding. Stay consistent and patient. Avoid emotional decisions during market downturns. The beauty of investing small amounts regularly is that, over time, it builds up to something substantial. Imagine reaching a point where your investments can fully cover your rent or even your entire lifestyle expenses. Risk management. Remember, all investments carry risk. Markets go up and down. Diversification is crucial. Long-term thinking is essential. Consider consulting with a financial advisor. Conclusion. Starting with just $20 a week might not make you a millionaire overnight, but it can set you on the path to financial freedom. The key is starting early, staying consistent, reinvesting dividends, being patient, thinking long-term. So what are you waiting for? Start today with just $20 per week and let time and compound interest work their magic. Remember, investing is a journey, and the sooner you start, the better. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell to stay updated with more investing tips. Let me know in the comments below, what's your favorite ETF to invest in? Thanks for watching, and see you next time on Wall Street Trends.